As we've been talking about, stocks closing higher today with big tech earnings leading that rally. It's coming after a slightly hotter PCE report this morning the traders did seem to be ready for. The new print also validating the Fed's higher for longer position. Here to help us break it all down for investors is John Baylor, Deputy Head of Equity Income and Portfolio Manager at Newton Asset Management. John, thanks for being here. I do want to talk about earnings first because we just heard Jared sort of running through what we've been seeing from big cap tech. And as you pointed out to us in your notes previewing this segment, you're looking at a market here where you've got a lot of high valuation stocks, high growth, which obviously people were bidding up today. And then you've got sort of a gap and then low valuation stocks. And what do investors do in that kind of environment? Do they chase some of these big cap tech stocks?
Yeah, so just to disclose, I'm a value manager, so I'm always going to tell you to buy value stocks. But I really think there's an incredible opportunity today in buying those cheapest stocks in the market. We're not a deep value manager. We actually have a three-circle approach, which combines valuation with business momentum and quality. And so we believe in avoiding the value trap. So you definitely want to find those companies that are at a discount, but you're focusing on a catalyst that's going to change that company's discount. It's going to re-rate that the valuation of that company higher. And you also want good balance sheets, high returns on invested capital. So that combination we think works over time. But currently, in the cheapest area of the market, you can actually find good quality companies that are also very inexpensive. So we really think that this is the time to focus less on earnings growth and more on valuation. It's very similar to the tech bubble, where for 10 years after the tech bubble in 1999, it was all about multiple compression of those most expensive stocks. And you didn't get that multiple compression of the cheapest stocks in the market.
I want to ask you about interest rates, and of course this relates to the Fed as well. Interest rates and the yield curve structure can determine whether value stocks outperform at various times, and it's been a while. We haven't seen value really outperform much this century. Do you see anything in the cards here? We're at the most aggressive rate hiking cycle in 40 years. Is it time perhaps for value to shine again, given the structure?
Yeah, I think it's a big mistake to focus on the last decade after the global financial crisis. I think that was the anomaly. If you go back, and I've got charts that go back 100 years, and you can see that interest rates, especially short-term rates, tend to hover around 4 or 5% where they are today. That is normal. What's not normal is the decade after the global financial crisis, where you had interest rates near zero, you had low inflation, and you needed to own those companies that could grow irrespective of what the economy was doing. So I think if we throw out that decade and say that was the anomaly and we're back to normal, I think you want to look back and see what worked in the last 90 years of those 100 years, and it was value. Very rarely does value underperform on a 10-year basis, rolling basis, before the global financial crisis. So I do think for lots of reasons, we're going to have a little more inflation, a little higher interest rates. Money isn't going to be free any longer, and value will come back into favor.
Well, it's interesting. I believe your biggest holding is JP Morgan, which I guess technically might be a value stock, but I don't think of it as a value stock necessarily. I mean, the stock is up something like 14% year to date, and it is very dominant in the zeitgeist, if you will. What defines JP Morgan as, is it still value? And so should they still get in here?
Yeah, so, JP Morgan is a great example of the type of companies that we like to buy. I mean, you look at this company, they're picking up share. They have very high returns on tangible equity. They've been generating 20% returns on tangible equity, which is fantastic. They also have an unbelievable balance sheet with over $1 trillion of cash on the balance sheet. I mean, Jamie Dimon, who's one of the best CEOs around in America, in that matter, in the world, he's kept a lot of cash on the balance sheet just in case interest rates would move higher, where a lot of his peers were going out in duration and trying to chase some yield. So a fantastic managed business. but you're still only trading on kind of a normalized earnings, 10, 11 times earnings. So, I would say that's still an inexpensive stock for all those characteristics. And you also have a dividend, which I think is important, that is high and is growing. They grew the dividend 10% just recently. So all indications that, we would say that's a high quality company, and the valuation still looks very attractive to us.
I want to ask you about energy, taking a little bit of a backseat today, but it is the number one performing, large cap energy is the number one performing sector in the S&P 500, up about 14%. Do you like anything in energy? We just had Exxon and Chevron results today. I don't know if you can speak to them particularly, but I'm more interested in your views on the sector and if it's large cap, if it's some of the smaller players, or something in between.
Yeah, and I would say it's something in between for us. So I can't talk about any specific names, unfortunately, in the energy sector, but I can talk about the overall sector. It's a sector that has really done a great job in terms of allocating capital in the last 5 years. If you look back during the shale boom, they were spending all of their cash flow that they were generating, putting it back into the ground, trying to grow production. That has been the case for 5 years. So really that shale boom that created too much supply, we believe is over. And they're using a lot of that excess free cash flow to pay out back to shareholders in the form of dividends. So we like a lot of the companies kind of in that middle space that are paying out special dividends. They're very high dividends. In this case, at $80, $90 oil prices, these companies are generating an incredible amount of cash flow. And what's really surprising to a lot of people is their balance sheets are fantastic. Some of them have net cash on their balance sheets, and a lot of them have very, very good balance sheets because we've had a number of years here of strong oil prices. So we do like the energy space. We're overweight energy in the funds.
All right, John, interesting stuff for people to chew on. Thanks so much for joining us.
Thanks a lot, Julie.